Options trading. You've probably heard the term, and for a lot of people, it sounds incredibly complicated, maybe even a little scary. Well, today, we're going to pull back the curtain. We're going to cut through all that confusing jargon and show you what these things really are. Powerful financial tools that might just have a place in your own financial journey. So let's just get it out there. The biggest question most people have is this: are options just a fancy way to gamble your money away in a financial casino? You hear these wild stories of people making or losing a fortune overnight. And look, that can happen, for sure. But that's only one tiny, tiny piece of the puzzle. It's kind of like looking at a chef's knife and only seeing a weapon, completely ignoring the fact that it can be used to create an incredible meal. And here's the secret, the thing most people don't realize. You already get the core logic behind options. I'm serious. You've probably used the same kind of thinking in your own life without even knowing it. We're going to connect all this complicated-sounding finance stuff to two super simple, everyday ideas that you'll recognize right away. Okay, forget all the math and the weird symbols for just a second. And look at this. Put options, that's just car insurance. They protect you if something bad happens. Call options, think of that as putting a deposit down on a house. It secures your chance to buy something later. If you can just lock these two analogies in your mind, I promise you, everything else is going to click into place. All right, you ready? Let's use these ideas to break down the 4 basic moves you can make in the options world. We're going to look at it from both sides, the buyer and the seller, for both puts and calls. First up, let's talk about protection. So, imagine you own a stock that you really like, but you're a little worried the market might take a dive. Buying a put option is exactly like buying insurance for your car. You pay a small fee, it's called a premium, and in return, if your stock's price crashes, your insurance policy pays out and protects you from taking the full loss. You're the car owner, just buying some peace of mind. Now, let's flip the script. What if you wanted to be the insurance company? Well, when you sell a put option, that's exactly the role you're taking on. You collect that premium from the car owner right away. That's your income. Your whole bet is that the car, the stock, won't crash. And most of the time, you're right, and you just get to keep that cash. But if that crash does happen, you're the one on the hook to pay for the damages. Okay, enough about protection. Let's talk about opportunity. This brings us to that second analogy, the house deposit. So you find a house in a neighborhood you think is about to take off. You think its value is going to go through the roof. You pay the current owner a small deposit. Now, this gives you the right, but not the obligation, to buy that house at today's price. If the value doubles, you just made a brilliant move. And if it doesn't, well, you only lose your small deposit. That right there is a call option. So what about the homeowner in that deal? If you sell a call option, you're the one who pockets that deposit. You get cash in your hand right now, which is always nice. But you've made a promise. You are now legally obligated to sell your house at that price you agreed on, even if the market goes crazy and it becomes worth way, way more. You get the guaranteed cash today, but you give up the potential for a huge jackpot tomorrow. Okay, now that we have the basic building blocks down, let's put them together. We're going to look at a really popular strategy, one that legendary investors like Warren Buffett have used. It's called the covered call. And really, the best way to think about it is like collecting rent on stocks you already own. And the process is actually pretty straightforward. Step 1, you have to own the house. In the options world, that means you need to own at least 100 shares of a stock. Step 2, you sign a rental agreement by selling one call option against those shares. And step 3, just like that, you collect the rent. That cash premium we were talking about gets deposited right into your account instantly. Let's use a real-world example to make this concrete. Let's say you own 100 shares of Apple. You then sell a call option, agreeing to sell your shares for $160 apiece, anytime in the next month. For making that promise, you instantly get paid, let's say $300. So what happens next? Well, there are pretty much 2 main outcomes. Outcome 1. Apple's stock price stays below $160. Perfect. You keep all your shares and you keep the $300. You can even do it again next month. But outcome 2. Apple stock shoots up to $170. Well, you have to stick to your agreement and sell your shares at $160. You still made a nice profit, but you did miss out on that extra gain above $160. And this is absolutely crucial to understand. This strategy is not free money. There are 2 big risks. The first is exactly what we just saw, the risk of selling too early. You might miss a huge rocket ship ride just to collect a small rental fee. The second risk, and this is the bigger one, is a market crash. That $300 premium you collected gives you a tiny, tiny cushion, But if your stock falls by 20 or 30%, you are still losing 20 or 30%. This strategy offers almost no real protection if things go really wrong. All right, we need to talk about one of the most powerful and misunderstood forces in options. It's this silent killer that's always working in the background. And if you're on the buying side of an option, it is your number one enemy. That enemy is time itself. This melting ice block is the absolute best way to picture this. Think of an option's price as having two parts. There's its real value, that's the coin frozen inside. But then there's all this extra value from time, and that's the ice around the coin. And every single day, without fail, the sun is out and it is constantly melting that ice, shrinking the value of your option. Now, in the options world, this melting effect has a Greek name, theta. If you see a theta value like this, negative 0.05, what does that mean? It means that every single day that passes, this option loses 5 cents in value per share. That's $5 for the whole contract. Gone. Poof. You are literally paying $5 a day in time rent just to hold your position, even if the stock's price doesn't move a single inch. But here's where it gets really dangerous. The melting isn't a slow, steady drip. It's not linear at all. When an option has lots of time left, it melts very slowly. But once you get into those last 30 days before it expires, the melting speeds up like crazy. And in the final week, it's like the ice block just falls off a cliff. The value vanishes at a shocking rate. This is why buying short-term options can feel like a frantic race against time. Okay, we've seen how options can be used in smart ways, and we learned about the silent killer, time. Now I have to give you a serious warning about the single most dangerous strategy out there, especially for anyone new to this. This is the one that can lead to absolutely catastrophic, account-destroying losses. Remember that covered call strategy we talked about? That's where you sell a call on stock you already own. Your risk is contained. Well, the naked call is its evil twin. It's when you sell that same call option, making that same promise to deliver shares, but you don't actually own the stock. And that one little difference changes everything. Your risk goes from contained to, and I mean this literally, unlimited. And here's why it's so tempting. Let's say you sell a naked call, and boom, $500 appears in your account. If the stock price stays flat or goes down, you just keep the cash. It feels like free money, right? That $500, that's your absolute maximum profit on this trade.
But what happens if you're wrong? What if that stock you don't own suddenly skyrockets? You are now legally forced to go into the market, buy 100 shares at that new insane price, just to sell them back at the old low price you promised. So on that same trade where your max gain was a measly $500, your potential loss could easily be this. And in theory, there is no ceiling. It could be infinitely more. This strategy has a famous and, frankly, terrifying description. It's like picking up coins in front of a steamroller. For a while, it feels great. You keep bending over, grabbing those little bits of premium. You feel smart. But you're not paying attention to that giant, heavy machine that's rolling right toward you. And eventually, it will catch up, and one bad trade can flatten your entire account. So as we wrap this up, if there's one thing you take away, it's this. Options aren't lottery tickets, and they're not evil. They're just tools. A hammer can build a beautiful house, or it can smash a window. The hammer itself isn't good or bad. Its power comes from the skill, the knowledge, and the intent of the person holding it. We started off asking if options were just gambling, and I hope by now you see that they can be insurance, they can be income generators, or they can be pure speculation. They can make time your best friend or your worst enemy. The beautiful part is, the choice of how to use this tool and which risks you're willing to take is entirely up to you. Thanks so much for tuning in.